Good morning. Today we are going to start a new chapter which is income and interest rate, the Keynesian cross model, and the IS curve. Let's start with the first part of this chapter, which is related to business cycle and the theory of income determination. Business cycle refers to the alteration of periods of rapid or slow growth in real GDP, or in another term, it's ups and downs or fluctuations in real GDP. So business cycle refers to the alterations of periods of rapid or slow growth in real GDP. The main objective of any country is to decrease or slow down these fluctuations. So the country can use monetary policy or fiscal policy in order to achieve this main objective, which is slowing down the fluctuations or keep the economy more stable. But in some cases, using monetary and fiscal policy increase or dampen business cycles and move toward an ideal world in which real GDP grows steadily from one quarter to the next. So monetary and fiscal policy can have positive or negative impact, both of them, based on their application. In this chapter, we are going to begin by the process of identifying what are these shocks, what are the shocks that will cause business inflation. Business cycles. Shocks causing when we are going to talk about shocks that cause business cycle, they can be related to shocks that's related to aggregate demand or related to aggregate supply. So what's aggregate demand? Aggregate demand means total spending total amount of desired spending expressed in current or nominal dollars or values, whatever the currency. What about aggregate supply? Aggregate supply means amount that firms are willing to produce at any given price level. So what are the shocks that's related to aggregate spending or demand shocks? Demand shocks is a significant change in desired spending. Desired spending by consumers, business firms, governments, or even foreigners. These are the four main sectors in the economy. So demand shocks means it changes in desired spending by any one of the four main sectors of the economy. For example, a change in consumer confidence and business optimism. This may cause a shock in the demand side. Um, Another example, a change in foreign demand for goods and services produced in a country. This is an external shock, and so on. What about the supply side? When we are going to talk about supply side, we have to put an assumption, one main assumption. Actually, we focused on studying of business cycle in the short run. So we are going to assume that prices or price level, in order to be general price level is fixed in the short run. So now we are going to focus on the short run, and we are going to assume that prices are fixed in the short run, or the general price level is fixed in the short run. As price level is fixed, all changes in aggregate demand automatically cause changes in real GDP by the same amount in the same direction, as changes in real GDP equal changes in aggregate demand and divided by price level or fixed price level. So once again, as price level is constant, all changes in real GDP, all changes in aggregate demand automatically cause changes in real GDP by the same amount and in the same direction. So now we would like to study the main components of aggregate demand in details and identify what are the changes in any one of them and how it is going to be reflected in aggregate demand and in real GDP as well. But before this, we have to differentiate between what we explain and what we take as a given. Or in other words, we have to differentiate between endogenous variables and exogenous variables. Endogenous variables are those explained by an economic theory. So endogenous variables are what we explain. What about exogenous variables? Exogenous variables are those that are relevant but whose behavior with respect to the economic theory doesn't attempt to explain. The economic theory doesn't attempt to explain the behavior of these variables. So their values are given. Or in other words, exogenous variables are what we take as given. For example, consumption function, consumption expenditure is an endogenous variable. And an example of exogenous variable, just like money supply. We cannot determine how money supply is determined or changes, why it's going to increase or decrease. Or tax rates are exogenous as well. What are the main components of aggregate demand? Let's for now talk about planned expenditure. Planned, or this is the aggregate demand, planned expenditure. Later on, we have to differentiate between planned and unplanned expenditure. But for simplicity right now, the difference between both of them is the inventory. Planned expenditure equals C plus I plus G plus net exports, or plus X minus M. Now we have to explain the first one of these components in detail. Consumption. What's the consumption function? What's meant by induced and autonomous consumption, and so on. We can write the consumption function as C equal CA plus small c y minus t. Let's start with a situation where C is the only endogenous variable. So C in this case is endogenous variable. It depends on the disposable income. Y minus T is the disposable income. Or we can write it as YD. Disposable income is the net income after the deduction of taxes or after the payments of tax. While CA is autonomous consumption. Autonomous consumption is completely independent of disposable income. So it is the amount of consumption that doesn't depend on income. A small c is known as marginal propensity to consume, or MBC, which is the slope of the consumption function, and it's calculated as a change in consumption due to change in disposable income. And this part, which is consumption, which is related to disposable income, is known as induced consumption. So this means that consumption can be divided into two main parts. Number one, autonomous consumption, which doesn't depend on income, and number two is induced consumption, which depends on income. So if you are going to write the consumption function as C equals 500 plus 0.75 YD, this means that autonomous consumption or consumption which doesn't depend on income is 500 Number two, if disposable income increases by $1, one Egyptian pound, one whatever the currency, consumption will increase as the relationship between disposable income and consumption is positive relationship. So consumption will increase by $0.75. Now we would like to illustrate the consumption function graphically. This is disposable income, and on the y-axis it is the consumption expenditure. The 45-degree line represents disposable income, and consumption expenditure has an intercept of 500 as shown in the equation. This is the intercept, which means if disposable income is 0, consumption will be 500, and then consumption is going to increase as income increases. So this is the consumption. Point of intersection of disposable income line and consumption line is known as break-even point. At this point, your domestic income, all of your domestic income will be used in consumption, and there is no savings, there is no borrowing. In this area, you can find that consumption is greater than income, which means that you have to borrow money or have negative savings. While after the break-even point, income is going to be much more higher than consumption, and the other result, we can save money. So in the blue area, there is positive savings. And in the break-even point, zero savings. So if you know that disposable income equals 2,000, what is the level of your consumption in this case? In this case, consumption will be calculated as 500 plus 0.75 multiplied by 2,000. So it will be 2,000. So this is the case of the break-even point. Your disposable income is equivalent to your consumption. At any different income level, you have a different level of consumption, and you have either saving, your income is greater than your consumption, or vice versa, your income is equivalent to, is less than your consumption, and we have negative savings. So if you would like to divide total consumption in this case to induced and autonomous, we have 500 autonomous consumption and 1,500 induced consumption. What about savings? The simplest way in order to show the amount of savings is using graph. As the difference between the 45-degree line and the consumption, the difference between both of them is the savings. So we can write savings as Y minus C, which is the disposable income, minus C. YG minus C. So this is savings. So if you are going to substitute in C using a consumption function, so it will be Y minus T minus CA, which is autonomous consumption, minus C Y minus T Y minus T minus C A minus C multiplied by Y, which is CY, minus C multiplied by negative T, which is positive CT, or we can write it as this is YT and this is YT, so we can take YT as a common factor, so it will be negative CA minus plus 1 minus C Y minus T, or in another words, it's negative CA plus 1 minus T YD. So just like consumption, we have autonomous consumption and induced consumption. This is going to be reflected in the saving function as negative autonomous consumption, and 1 minus C. 1 minus C is known as marginal propensity to save. As we said that disposable income will be divided into consumption and savings. So the percentage of disposable income that's used in consumption is C, and the small c, which is marginal propensity to consume, and the percentage of of disposable incomes that's going to be used in the as a savings is 1 minus C. So marginal propensity to save is the change in savings due to change in disposable income. Okay, this is the main idea of one of the main components of planned expenditure, which is consumption. As we said, consumption is going to be divided into two main parts, and this will be reflected in savings function as well. What are the other factors that can affect consumption other than income? Number one, interest rates. Actually, interest rate will affect the decision of the consumer whether to increase consumption or to save money. So when interest rate decreases, this will encourage people to borrow money, and autonomous consumption is going to increase. Factor number two, household wealth. Household wealth is the net total value of all household assets. So it is the value of assets minus any debt, including the market value of homes, any positions such as cars, financial assets, and so on. If wealth increases, household spending can rise even if income is fixed. Of course, if we are going to talk about factors affecting consumption, we are going to assume that income is going to be constant, and we are going to change any other factor. Okay, so here there is no need to write that in this case income is going to be fixed. Actually, it's going to be fixed. So consumption will increase in this case. So later on, we are going to use these factors in order to know how this will affect the business cycle or cause a business cycle, cause a change in the business cycle. Now we would like to differentiate between planned and unplanned expenditure. Recall the national income accounting identity, which states that Y equals C plus I plus G plus net exports. GDP or output is unplanned expenditure. Unplanned expenditure always equal GDP because the equation is an identity. What about the planned? Planned expenditure which is known as EP equals C plus IB plus G plus net exports. So the only difference between planned and unplanned in the equation is related to IB instead of I. Or in other words, it's related to investment. Investment has unplanned spending, unplanned spending component. Goods that are produced but not sold in the market or unplanned inventories is the main difference between planned and unplanned expenditure. So the main difference or the main change between both of them is the unplanned inventories, which are goods and services that are not sold in the market. So actually, GDP, which is the planned expenditure, will be equivalent to unplanned expenditure only in, GDP, which is the unplanned expenditure, will be equivalent to the planned expenditure in just one case, which is the equilibrium point, or there is no unplanned spending. So we can write it as EB equal AB plus C Y minus T, where AB is the autonomous spending, which includes CA, which is autonomous consumption, IB, which is planned investment, G, which is government expenditure, and NX, which is net exports. Y minus T, which is disposable income, CY minus T, which is induced consumption. So the economy will achieve equilibrium. In this case, there is no unplanned inventory, and in this case, Y will be equivalent to EP. Or real GDP would be equivalent to planned expenditure. So in this case, Y will be equivalent to AB plus CY. In this case, we are going to assume just for simplicity that T equals 0. There is no taxes. To find the value of equilibrium Y, we are going to solve the equation for Y. So CY will move to the opposite side with to the other side with opposite direction or opposite sign. So it will be minus CY equals AB. We are going to take Y as a common factor. So 1 minus C Y equals AB. 1 minus C is small s, which is marginal propensity to save. Y equals AB. So we can write equilibrium value of Y as Y equal 1 over S AB, or 1 over 1 minus C AB. So this is equilibrium Y, equilibrium level of GDP. If there is any change in autonomous planned expenditure, output or real GDP is going to change as well by the value of the multiplier. By the value of 1 over S. 1 over S in this case is called the multiplier. Multiplier means how each additional dollar of autonomous spending result in greater than $1 increase in equilibrium output. Multiplier means magnification. How each additional dollar of autonomous spending results in a greater than $1 increase in equilibrium output. Don't forget that the multiplier in this case, based on assumption that there is no taxes and net exports is exogenous, not endogenous. Okay, as we can have a new form for the multiplier if we add taxes to the equation, or if we are going to assume that net exports is endogenous, not exogenous. Now we would like to compare between two situations: economies always true case and equilibrium situation case. This is case number 1, always true by definition. Number 2, only in equilibrium. What concept of expenditure is equal to income? In case of in case of always true by definition, actual expenditure including unintended inventory accumulation. This is actual expenditure, which is planned expenditure plus unintended inventory. In this case, in case of equilibrium, there is only planned expenditure. So by definition, actual expenditure includes planned plus unintended inventory. But in case of equilibrium, there is no unintended inventory, and the actual will be equivalent to planned expenditure only. Amount of unintended inventory investment. In case of always true by definition. It can be positive or negative. While in case of only in equilibrium, it will be 0. Which equation is valid? Equation representing y, okay? In case of by definition, true by definition, y equals E, which is the summation of EB plus IU, which is unintended inventory. While in case of only in equilibrium, y will be equivalent to EB, as this is the equilibrium condition. What does the economy where does the economy operates? Okay, in order to answer this question, we have to illustrate planned and unplanned investment graphical. Sorry, planned and unplanned expenditure graphical. This is real income. And this is planned expenditure. Just like the case of consumption, we have a 45-degree line represents income level, and a line represent consumption. Instead of consumption, in this case, is going to be a line represent planned expenditure. So this is a 45-degree line, which is income level. Or at this level, E equal Y. And we have planned expenditure, which has an intercept. This is EB, planned expenditure. This is the point of equilibrium, as there is no unintended inventory in this case, or Y equal EB. At any level below or above, we have unintended inventory, either positive or negative. So in this case, EB is greater than Y, and in this case, Y is greater than EB. So we have either positive or negative unplanned inventory. Now returning back to our question. So where does the economy operates? In case of always true by definition, any point on 45-degree line, at any point on the 45-degree line. While in case of only in equilibrium, the economy operates only at one point. Say, for example, this is point B. And this is point A. So in case number one, any point on the 45-degree line, just like point A. This is just an example, okay? But in case of only in equilibrium, only one point, which is point B, the economy will operate only at the point where EB crosses the 45-degree line. Okay, next time we are going to explain factors that affect or shifts the planned or unplanned expenditure and how this is going to affect the equilibrium level in the economy. Thank you and see you next week.